So first, let's just start with a few key takeaways for the region. And this is really the most important things that executives need to remember going into 2022. So first of all, is we still expect economic recovery to remain robust throughout 2022. And in fact, it should firm as regional labor markets gain pace. The second major point really is that the relatively high vaccination rates across the region should prevent the introduction of tighter COVID-19 restrictions. So nothing really what we've seen in 2020. We have seen countries, of course, introducing measures to requiring vaccine passports for individuals to visit public places, but still relatively high vaccination rates means that the risk is subsiding. The third major point, and this has been in the headlines quite a lot, but we expect inflationary pressures to moderate throughout 2022. They should remain relatively elevated in the first half of the year, but should ease steadily going forward. Next, we do expect labor market recovery to continue. This should ensure a resilient rebound in consumer spending. And in fact, we expect consumer spending to remain one of the key drivers for these economies. Finally, I should also point out the structural weaknesses in markets such as Greece, Spain, Italy continue to weigh on the outlook, coming both from the labor market and also really from the precarious public finance situation in which these markets find themselves in. I also want to draw your attention on the next slide to the epidemiological situation. Now, Mark touched briefly upon this, but there are several main points that need to be highlighted. First is that even though we've seen new cases rising throughout Western Europe, a lot of it stemming from the lifting of restrictions, high vaccination rates so far have prevented a dramatic increase in hospitalization rates, meaning that even though we see this increase in cases, in reality, the vaccination campaigns seem to be working. Hence, this supports our view that we shouldn't see new lockdowns or any the introduction of any new strict restrictions. And also just comparing these markets on a global level, it's quite evident how effective these vaccinations campaigns have been. And in fact, despite an early lag in the beginning of the year, these markets have managed to quickly catch up in terms of vaccination rates. And on the next slide, you can see how governments have really responded to these developments. So we've seen restrictions being lifted quite consistently throughout March and June. Again, as I mentioned earlier, we have seen governments actually introducing some restrictions when it comes to the vaccination passports, but the fact that the vaccine seemed to be working means that we should continue to see this easing of restrictions quite consistently going forward. On the next slide, you can see how this lifting of this restrictions has interplayed with domestic mobility, which is typically a very good indicator of consumer spending. And we've seen actually mobility in these markets bouncing back to almost pre-COVID levels throughout May and June. Now in the UK, in May, mobility there still lagged a bit, mostly because of per individual hesitancy. But the fact remains that we have seen very high mobility elasticity, which should support this recovery in domestic demand. On the next slide, you can see a deeper breakdown of growth across these markets, and this really illustrates both the main opportunities, but also the main risks in these markets. So we see quite consistent growth throughout 2021, firming in 2022, and then easing actually quite substantially in 2023. Regardless, it's quite evident that Northern European markets, specifically Germany, have performed quite well. And even though growth there is a bit more muted when you compare it to the rest of the regions, a big factor behind this is the fact that the economy contracted relatively mildly in 2020. We see an uptick in 2021 and a mild acceleration in 2022 as labor markets continue to firm, and as we see exports growth really boosting growth in Germany. Now, of course, it's quite evident that markets such as Italy and Spain, they are seeing this sharp rebound, but in 2021. But it's important to remember that this is coming from a very base case in 2020. We do expect this growth to continue to be elevated throughout 2022, as I mentioned, on the back of these labor markets improvements. But still, the recovery in Southern Europe in general continues to be a bit more precarious, continues to lag behind, especially when you compare it to Germany. On the next slide, you can see our currencies forecast. So what we've seen so far is and what we expect to happen in 2021 is the euro to broadly strengthen against the dollar. The same goes for the pound. Now, going into next year, 2022, is we do expect the euro to further strengthen mildly against the dollar. A lot of it stemming from the stronger recovery, firming of growth in exports, and some of the scaling down of the ECB's asset purchasing scheme. However, going into 2023, MNCs and executives should keep in mind that the expected monetary tightening in the US should lead to some slight depreciation of the euro against the dollar. Now, when we talk about the pound has actually outperformed in 2021. Given the relatively fast rebound of the economy. However, going into 2022, we do expect export issues and the ongoing Brexit problem to actually weigh on the outlook of the pound, and we do expect some slight easing that will extend into 2023 again as the U.S. Feds begin to tighten monetary policy.
The only point I would add to this regarding the currencies would be that's having spoken with executives and just getting the sentiment in terms of planning, this currency outlook is far more sort of, I guess, optimistic for these scenarios, or more optimistic for companies compared to the last 5 to 6 years, when these currencies actually were far more volatile, a little more unpredictable than both the euro and the pound had been historically over the last several decades. So actually, this is quite a relief to see much more consistency, much more stability, much less volatility of both the euro and the pound against the dollar during this planning season as we look ahead for really about the next minimum year or even up to 2 years. So this is actually very good in terms of your ability as executives to plan for this coming year and next year, since there should be far less volatility, less risk factors, and as Martin mentioned, minimal, if anything, appreciation over time of the euro against the dollar. And again, minimal, nothing terribly dramatic, but minimal consistent depreciation pressure on the pound going into next year and beyond for the next couple of years. So generally consistent trends, which of course will aid planning for your business.